And now we're going to get some information that's going to empower us and help us. And it's going to be a very, very good day. We want to officially welcome you to New Vision International Ministries. My name is Dexter Upshur. I have the privilege and the honor of serving as the senior pastor here of New Vision. And welcome to our campus. We're located here on the west side of Bridgeport. This is actually 65,000 square feet of property. You're on the second floor. There's a first floor with commercial tenants and all that stuff. Then there's a whole other side of our campus that's focused on community development and empowerment. And this is part of our initiative to make sure that our community is equipped, because we believe that Jesus is concerned not just with our spirits, but also with our entire lives, that we are mind, body, and spirit. And so initiatives like this help to equip us to live life well and to live life skillfully. So last year, we had the opportunity to do this for the first time in conjunction with First County. And it's such a privilege and honor to do it again. And for you guys to join us, we have people that are here in the building physically. We also have people that are watching via the live broadcast. And this is just an opportunity for us to really grow about something that's really important to our community, which is home ownership. It's important that you understand what that is, what opportunities may present themselves. And then also, if you aspire to do something, you may not do it this year, but what you do in this year will help you 2 or 3 years down the road. So we want to bring the information to you. And that's part of what we do just as a church community. And it's great to have great partners. And we have all these partners up here on the stage. We want to welcome them. They'll introduce themselves in their own way. But I have to give a shout out to Beth. Raise your hand, Beth. There's Beth. She's right behind me. She's going to turn the mic on.
Hello, how are you?
So Beth has been the glue that's helped to bring all of this together. And before I yield the stage to her, and she's going to moderate for today, I'd like to just speak a prayer and a blessing over this gathering so that we can come together and really make an impact beyond this moment. Would you pray with me? Let us pray. Oh, great and holy God, we thank you so much for this day. This is your day. We will rejoice and be glad in it. We thank you for all the people who spent time in worship, whether it was here and other places. We also thank you for this convening, and we ask for your Holy Spirit to be present, that you would help lead us and guide us. We thank you for every household that's represented, every individual that will listen to this information and take it back home and apply it to their finances and their family. Lord, would you give us direction? And we pray that you would be glorified in this. Bless each and every speaker, each and every panelist, that the information that comes forth would be helpful to those who are listening. In Jesus' name we pray, amen.
Good afternoon, everyone. I hope everybody is doing well. I'd like to thank you for coming and joining our home ownership workshop today. And I'd like to thank Pastor Dexter, Paula Moody, and Shamar Holmes for actually helping us make this happen. Just a few housekeeping. First, I think I'm missing a clicker to flip the presentation. Pastor Dexter, I think there's a clicker, right? So I can flip, yes. Second is that we have some giveaways outside. Please help yourselves to it. Also, we have a raffle today. So make sure you've signed the sign-up sheet. Have you all done that? Okay, because that's where we're going to get the winner. So please go out and sign the sign-up sheet. So as in last year, we are going to provide you with a lot of information by our presenters. So it's very important for you to listen. Some of it may sound repetitive. Ignore the repetitiveness. I think it's important that you listen and these things be reinforced in your minds so that you actually can prepare yourself properly for home ownership. They are required steps that you need to take so that when you're ready to make an offer, you look like a strong buyer to the seller. So I'd like to actually, also I believe you will have some questions. Please hold off the questions till after the Q&A section, which is towards the end of the workshop. So I'd like to actually start by introducing our speakers. We also have a raffle. It's the smart TV, a bank iPad stand, and a welcome mat. We'll flip the screen. Flip another screen. Okay, so the list of speakers will be myself, Pastor Dexter, Roxana from HDF, Jackie Alge from HDF, Attorney Andrew Brucker, who is the ministry attorney, And we have Jake Strait from Joe Strait. I'm sorry, that should be Joe Strait, Cornerstone Home Inspection. Stephen Roberts, he's the one that you guys should really go after if you have credit issues. And we have the realtors. So let's flip the screen. We have Vera. We have no need to introduce her. She's with the church. We have Virginia Klein from also REMAX and Matthew Langston. Now, Ayo is not here today. She could not be here today, but she did send us a presentation and a video of her, or I think a recording of her presentation. So she will actually do that. So let's start our presentation. So we'll start with Virginia Klein.
So I love what Pastor Dexter said, aspire. I've been in this business for 56 years. How many people own a home? Good. How many people want to own a home? So I'm glad it's important to you. So I've got the math and I've got the reasons to probably, in Pastor Dexter's words, aspire to ownership. And if you have ownership, what it means to you in your future. So I'm ready for my first slide. Well, does that look clear to you from back there? Doesn't me either. So I'll try to talk you through it. I went back 30 years because today what we hear is, oh, the rates are so high, the rates are growing, right? So we're all afraid of, oh, we missed the good rates, the rates are, so what do we do now? But I went back to 1975, and we're at an all-time low on rates. They were 8, 16%, 13%, 10%, 9%, 7%. 2002, they were at 805. So they had gone from like 16 and 18. I bought my first house at 18%. In 2000, they started down from 805. And today they're at 5. When this came out a couple of days ago, they were at 534. Beth's talking 6 and 7% today. So rates, although people want to believe they're really high, they're the best they've been in the last 30 years, a string of years in a row, so since 1980. So don't be afraid of rates. Don't let rates keep you from buying. So now let me go back to the second slide, if you will. If you are renting a home, the average rent in Fairfield County today from 2009 to 2022 is up 36%. And the average rental in Fairfield County today is $4,000. So what we were used to is maybe 500, 800, 1,200, 1,600 is gotten to be 2,000, 2,500, 3,000. And that's what you're looking at as a rent today. The average sale price for a single family and condo in Fairfield County between 2009 and 2022 is up 54%, with the average sale price today of $620,000. The average fixed rate in the last 13 years has been 4.41%. Now, what does all of this mean to you? If you're at a $3,000 a month payment at 4.41%, you're buying a $600,000 house. That seems like a lot of house and a lot of money. But if you had purchased a house, that same $3,000 would purchase you a $600,000 property in 2009. Today, that property would be worth $924,000. Are you with me? Does that make any sense at all? If you'd purchased at $300,000 way back then, in 2009, that house today is worth $462,000. Now here comes the real numbers. In the last 13 years, over that same period of time, if you were at a $1,500 a month rent, which would have been buying you that $300,000 house, you would have taken out of your pocket, gotten nothing back for it but a house, place to live, $253,000. So your cost over those same period of time was $253,000, but the profit that you would have made, or what you would have over and above the value of their purchase, was $162,000. So you've spent a lot of money to have nothing to show for it. So if you aspired, Pastor Dexter's word, which I think is just brilliant, the thing to try to do for you in ownership is how do you use that? What do you do with it? How do you build on it? Do you buy some future properties to help other people, to rent, to do whatever? But let's say that for the first time home buyer, this group of people are here to help you put that program together. So no matter where you are, no matter what your needs are, there's people in this group that can give you assistance and advice to help you get to where you're going. Nothing wrong with renting if you choose to be a renter, but there's a whole lot to gain with home ownership. And I would say just lean in to the people that want to help you, that are here to help you to get you where you want to go. Was that helpful at all? All right. Thank you for your time.
Thank you, Virginia. Yeah, you know, that's very true. When I first came here, I was an immigrant, and that was the first thing I really strove for, was to buy a house. And I am where I am because I bought that house, and I built the equity over time until I kept on buying more and more and more. So our next speaker will be, she's not here. Are we ready for Ayo's presentation? Okay. Just one more reminder, because some of you have just walked in. Make sure you've signed the sign-up sheet, because that's where the raffle winners will be drawn from. They're outside.
Hi everyone, my name is Ayo Haynes and I'm with eXp Realty. I'm so sorry I can't be there with you today. I'm actually on a business trip out of town, but I wanted to still give you a presentation about working with a broker as a buyer. But first, let me tell you a little bit about myself. I'm originally from New York, yay, New York City, but I have moved to Connecticut and I absolutely love it. I love selling homes here. I love representing buyers and sellers and investors. And I've actually been featured on a number of different shows. Selling New York on HGTV. I've been in magazines for real estate. I've won awards for my business acumen. And 17 years later, I'm still in real estate. In fact, I just accepted a role as the team leader for the Southern Connecticut team of Premier Group, which is a national group within eXp Realty. So let's talk about real estate. Real estate is, it's wonderful. It really is. It's a wonderful way to build wealth. And as a homeowner, you have the ability to select your agent, who you want to work with. And why is that important? Because your agent is going to give you insight into the market that you normally would not have. You want an expert who's going to hold your hand, and as a first-time buyer, home buyer, you want somebody who's going to answer your questions and be very patient with you. And so me and my team, we do that. We answer questions. We hook you up with people who are going to help you along the process, because it's not just me that's going to bring you to the finish line. It's a team of professionals. It's going to be your agent, your attorney, your mortgage broker, your title person, your appraiser, your insurance person, and then we finally get to the closing table. Yay, and we celebrate your success. So there are all so many things that you can do, but the most important thing is to start with an agent. In the state of Connecticut, you also need to have a buyer's agent agreement with your agent, because there can be so many things that go wrong in the relationship if it's not delineated who pays the commission, what the responsibilities are. And so the first thing and the best thing you can do is to have an agent provide you with an agreement that you're going to sign and agree to. It basically says that if the seller does not pay the agent's commission to the liking of the agent, so perhaps the agent is only receiving 2% from the seller, but their regular fee is 2.5%, the agent may say in the contract that you as the buyer has to make up the difference of that 0.5%. You have to agree to that beforehand, and they have to tell you if that's not going to be in place with every home they show you in advance. If they are only going to accept 2%, and the listing is getting 2%, then it's not an issue. You won't have to pay anything extra. But it is certainly something that you should consider prior to going into a home to see that particular apartment or house.
Is the presentation of IO done, I believe?
If you have any additional questions, don't hesitate to call me. Reach out to me via text or email. You can scan the QR code on the screen, and I'd be happy to tell you more about the home buying process. My team and I are ready and waiting for you to be successful in this market. Also, if you've ever considered a career in real estate, I'd love to tutor you or mentor you. It is a phenomenal way to make a living. It is a phenomenal way to build generational wealth. It's a phenomenal way to actually build your sphere of influence and also perhaps become a property owner yourself. I would love to have an opportunity to talk to you about a real estate career at EXP with the Premier Group, or answer any of your questions about the potential of being a real estate agent. Have a wonderful day. God bless.
Thank you, Ayo. So our next speaker, that was really a very nice talk, and I encourage you to actually take the contact information. We flash it out. We flash it on the screen. Take down the names and the contact information of our speakers. We've vetted them. They are trusted partners, so we encourage you to really reach out to them. Our next speaker is none other than Vera.
Good afternoon. For those of you who don't know, I'm Vera Maximin, and I'm really thankful to be here today. I didn't want to sound redundant with my information, but if you can put up my slide. I knew that the other agents would probably be talking about the process of buying a home, but I'm here to inform everyone that if you don't have a home, you have to get one, because by the year of 2030, 40% of the jobs are going to be wiped away through automation, okay? Also, I was looking at the stats in Black home ownership. They are the lowest since 1968, okay? Since 1968. And since the past recession that we had, our communities have suffered the most. And how we could combat this with the automation and AI that's coming on, and that's going to take away some of this, is real estate. Everybody in here should own a piece of real estate. Now, if you say, well, my credit is bad, I don't have money, listen, there are alternative ways you can get creative in owning real estate, leveraging, pull resources together. If you don't have the credit, maybe somebody that you could partner up with, because there's really power in teams and partnering up. I own some property that I was very creative, because at the time my credit or whatever, money or whatever, I owned plenty of investment stuff like that, where it was distressed, people needed to get out, I gave them some money to move on, and I took over the payments. There's many ways in order to get real estate. Not to mention many of these homeowner programs that we have. I believe Bridgeport had one that was giving up something like almost $90,000. The time, it's actually time to, it was more, how much was that, like 50? 50,000. But I think you were telling me you got someone up to like $90,000.
It was a different grants, the Bridgeport grant, the TTO grant, and a lender grant.
Right. Yeah. So now there's really no excuse though if you can't. If you don't have the money, there's programs out here that can help you get the down payment. And then if your credit, I would suggest that everybody work on their credit too, because credit is another thing that keeps us out of the game. Okay? So maybe you could come to the table and partner with someone who has the credit, and maybe you have the down payment. Some of these things you could get a mentor, get a coach, partner up with somebody, contact me, reach out to me. If you guys want my ebook, I'll send you I'm revising it because so many things have changed in this game that really, if you see my next slide, it was called State of an Emergency. That's how serious the time is right now for us to get in this game and really take advantage of some of the opportunities that are out here. And the only way that we can do it to get in the game with minimum money down is home ownership, buying your first property. And maybe that first property should be a multifamily. Maybe you should start off with buying a 4-family. 90% of the millionaires and the billionaires make their money through real estate. So if you don't own real estate today, get in the game. There's cheap land. You could buy land for a little nothing all over the U.S. America is on sale right now. And right now we're heading into a recession. Some things are going to be different in the next year or coming the end of the year. And I want you to be able to position yourselves to where you could be victors and not victims and take advantage of these crises and recessions and depression or whatever it is. Because we know that the word says our God will make our souls fat in the time of famine. So even though there's a famine in the land, we can still prosper. You understand me? We can still prosper. So everybody here today, and I'm sorry, I hope this gets to everybody to hear this. Real estate, own a piece of real estate. I don't care if it's a piece of land. I think I picked up a piece, a lot in Florida for like $5,000. $5,000. I made, and connections. I just made the woman like me. She said, Vera, my parents died in Florida and I don't see anything I'm doing with this. I didn't even see the lot. I bought so much property like that. I never even saw it. I just said, I want it. Yeah, that's what I do. I don't tell nobody, I'll take it. Let's do the deal, wrap it up right now. You understand? Because even though if I don't have the money right then and there, I'm going to get the money. Do you understand? Make the step. Faith without works is dead. You understand what I'm saying? Make the step, and God will help you. He will bring people to you to help you, to equip you, to aid you. The tools, the resources will come to you in order to make these things possible. You need to do this for your children. We need to leave legacy for our children's children. I'm going to be leaving everything to Abigail. Abigail's going to do it right. But we need to leave a legacy to our children and not bills when we leave here. Not passing a hat when we leave here. You understand? Everybody in here should be insured. Everybody should be insured. Insurance is very little money when you're young. Simple investment strategies that you could take. A lot of you are young, saving $50 or $100 in the stock market or whatever, a fund. By the time that yields and you got compound interest, in another 20 years, you'll have like $300,000 or $400,000. Simple things that can be done that can change your life, your children's life, and your children's children. Okay? We're going to do this together. I am here. If you guys need me, if you could email me, reach out to me, and I'll send you my ebook, and I'll send you the original presentation that I have for this, because it was actually, I think it was like 15 slides long, and she was like, no, Vera, just 2. But it's just on some information on where I think the market is going. If you want to get in the game, I know that the interest rates are high. That's why you need to get on it and do it now, because they are going to go up. They went down a little bit, but they're going to go up. And just think, you have to rent anyway. You always are going to need a place to live. So if you need something to offset your money, start off with a multifamily and build from there. All right, folks? Thank you for having me. I love you. Godspeed.
Thank you, Vera. So now I'd like to actually put my slide up just to introduce who First County is. They're a local community bank. We actually are more customer relationship focused. So First County Bank was founded in 1851. So we're 172 years old. So we started as a mortgage company where we do a portfolio lending, and also we do the regular lending. Our focus is unparalleled customer service and personalized attention. What's important to us really is helping you. So many of my clients, and Vera mentioned this, they may not qualify for the programs that we have, but I have access to other programs that you may qualify and may help you. And so therefore, I will lead you to trusted partners that we have to be able to help you into the process or home ownership. We believe in community support through participation and leadership, and that's why we're doing this for your church. And we also have the financial strength and stability. I think 172 years in the business is enough strength and stability. And we create an environment of inclusion and diversity of our employees and our clients, and we are trusted advisors. And again, I repeat over and over again, please utilize the list of speakers that we have right here, because each one of them can help you and will be able to help you and will be very willing to do a one-on-one basis of helping you. Our next slide. Okay, we want to do the steps of home buying. Attending a Homebuyers Workshop, you're doing that now. A pre-approval process, which is going to explain by Matthew for me. The mortgage process and the options, the housing search, purchase, sale, contract, property condition, mortgage processing and underwriting, and the closing. I summarized actually what the buyers today are facing. It's a very challenging market. You're going to hear some realtors that say there's lack of inventory that's pushing the market up, prices of home up, higher rates. Lenders are supposedly becoming stricter in their policy or underwriting policies. Let's talk about the rising interest rates. As of last week, prime went up to 8%. Prime was 8% 25 years ago in 1998. Last year, prime was at 3.5%. Now, prime is usually higher than the fixed mortgage rates that will be offered to you. Right now, our first-time home buyer for our banks and some of the local banks is at 6% with 20% down, credit scores of 740. One of the major things that I'd like to focus is actually what causes your interest rate to go up? Why do other lenders offer you a higher interest rate? Well, first of all, they look at loan to value. So if you put down less than 20% and the bank doesn't have a very good first-time home buyer program, your rates may go up, okay? It could be your credit scores. If your credit scores are below 720 or 740, there is a hit that Fannie and Freddie are the two government-sponsored enterprises that buy mortgages from banks so that there is available capital. Okay, they will hit you with the rate because you're putting down less, and therefore they look at it as a higher risk. Okay, and now they've added another layer of risk assessment, which is the debt-to-income ratio, which I'll go over later on. And that's actually your total debt over your income, and it comes up with a number. And right now, they're saying that if your debt-to-income ratio is over 45, Fannie and Freddie can increase your rate. So let's flip and prepare yourself for the biggest purchase of your life. And I'll turn this mic now to Matthew, who will actually talk to you about the pre-approval process.
How's everybody doing today? I'm Matthew Langston. I'm with Rising Legacy Realty. I'm a real estate broker for the state of Connecticut. Real quick, this is a part that's really dear to my heart. So, after you realize that you're better off in buying a home versus renting, and you've talked to a realtor that you trust and you want to work with, the biggest part is the mortgage, because that's going to be your financing. That's going to give you the ability to be able to acquire the process. And the one thing is you have to choose a trusted partner, someone like Liz from First County Bank that has got your best interest in. And what they're going to do is they're going to bring you into their office and they're going to talk to you. First thing, they're going to have a conversation with your credit, how much money you have in your bank account. Sometimes you need money, even though there's programs, you still need some savings to purchase a home. The next thing they're going to do is they're going to ask you how much rent you're going to be paying. What is your ideal monthly payment that you're going to be looking to pay in a mortgage? So they're going to have these conversations with you. Because what's going to happen is in these conversations, reality is going to hit. You may be paying $1,300 in rent. Now your mortgage payment could potentially jump to somewhere around $2,500. Are you willing to pay it? Now, just because on paper it says that you're able to purchase it, it doesn't fit your lifestyle. So you're going to have to make some sacrifices if you want that type of home at $2,500 monthly payment. If not, what they can do is they can kind of go over numbers where your comfort level is, and that's going to determine what your purchase price is going to be based on what your ideal monthly payment is. Because one thing that you don't want to do is go out and go look at homes. You say you can afford $300,000 and you fell in love with the house. And what happens is when they tell you that monthly payment, you're like, no, I can't afford it, or I'm not willing to pay that. Now your dreams somewhat, get diminished. But by having these conversations up front, you put yourself in a position to be able to move forward. Let's see. So the difference between a pre-qualification and a pre-approval. Pre-qualification, they're just going to take your Social Security, run your credit, look at your income, and based on those numbers say that you can afford this amount. A pre-approval is something that First County Lending does, and what they do is they actually take you through the whole process. You go through underwriting, and they're going to come out with an actual approval. And it's going to say that you're approved for this amount, and all you need to do is get an address and do an appraisal inspection, and you pretty much can close. What are you closing today?
We close 5 to 10 days, because if you have that, we call it a pre-commitment. So most of the pre-qualifications really, honestly, is mostly what you do online. You put in your income, you put in your assets, they don't really look at it. Whereas with First County, we believe that it's useless to have that. So we actually have the underwriter put you through the whole process of approving you, verifying your employment, doing everything that we need to do, and having the underwriter sign off. It's not just a loan officer giving you a pre-approval letter. It's an underwriter saying the bank is committed to actually give you X amount of loan. And your programs will be in place. So if we partner with HDF, so we also secure a pre-approval from them. And if you're borrowing more than 80%, we also have the approval of the mortgage insurance company. Because sometimes the mortgage insurance companies can give you a problem and not approve you at the end. Okay? Thanks.
So what does that mean? Now when you go out into the marketplace, actual pre-approved letter will give you strength in the market. That can help you win in this type of market where we're seeing multiple bids on certain houses, and that can help you win that house. So it's a good thing to go through the underwriting process so that you know that the money is there, and all you have to do is find an address. Let's see where are we at right now. We talked about that. I think it's back to you with documentation, Liz.
Right. So
right.
documentation.
Thank you.
This is always, thank you, Matthew. Documentation is always stressful for clients. Well, banks need to analyze your documents. Why do I say it's much better to have the underwriter analyze your income? Income is calculated in different ways. And HDF is actually, they're going to talk about that in detail. So you need actual documents. If you're doing a down payment assistance like with HDF, they need 3 years, correct? We need 2. So when I'm actually referring to HDF because they want the 100% financing, I will ask you for actual documents 3 years. I don't need images of your documents. What I do need is a scanned document PDF. We do not accept images, except for maybe your W-2 and your driver's license, we will accept images. But when they're documents that we're looking for, we need the actual scanned documents sent to us. And we need your 1040 or your federal return signed, okay? And many times I will also ask you to get your transcript from the IRS because we are supposed to vet or verify that the document that you provide us, the 1040 that you provide us, matches the 1040 that you submitted to the IRS. So there are no images of document, no electronic copies of documents are preferred. Send them via secure encrypted email because right now you don't want identity theft. And banks will normally send you an encrypted email so you can send it securely. Credit authorization needs to be, the permission needs to be in writing. Many of my colleagues in the mortgage industry right now pull credit with just you on the phone. Well, no, our bank, we actually literally get a permission, a written permission from you. Income documents, asset documents, you're doing 100% financing, don't be surprised that we will actually require you to have some savings. Normally with 100% financing, they want at least 3%, 1% of your own funds. And what is that for? Well, you know what? When you come to closing, you need money to pay your closing fees. The bank is not going to pay these closing fees, your attorney fees, your title fees, your appraisal fees, and so on and so forth. Property docs, if you don't have a mortgage right now, we need to actually see proof of rent, you know, and if you have a mortgage right now, we will need the mortgage statements to actually show that you have been paying your mortgage on time. Let's flip the slide. Now this is the debt to income ratio. After 2008, the government or the banking commission has required lenders to make sure that our clients or our borrowers have the ability to pay. It's not the equity of the house, but your ability to make the monthly payment. And how do we calculate that? Well, it's your total debt, your car loan, your student loan, your credit card debts, divided by your gross monthly income. Now, if you're self-employed, it's the net monthly income. And if you're hourly, we average that for the last 2 years. Okay? Let's flip. Electronic disclosures and applications are after the loan commitment. Borrowers, you have to sign the disclosures. Borrowers will sign most of the disclosures electronically, so you don't have to come to me and sign physically. Hard copies of these documents are sent to you by email or mail. And sending documents securely by encrypted email is very important. Let's flip. Flip the slide, please. Okay, so the loan application is when I take your information, pull your credit, get all your documents, and put them in. An appraisal and credit report, we will order the appraisal and credit report when you find the property. Okay, flip. Application process, the underwriting and approval, I'd like to leave that for HDF. Let's flip. Closing scheduled, I'll leave that for the attorney, and required items to be brought to the closing, I'll leave that to the attorney also over there. So I guess I'm done, and when you close, you will enjoy your home, and I'd like to switch now, I think, to the credit specialist, Stephen Roberts. Let me see. Next. Oh, no, we're not in the right slide. Stephen Roberts.
I'm going to go. How about that? All right, I don't really have a slide anyway. I like to just get up here and talk. All right, hello everybody. My name is Stephen Robert. I'm the CEO of Bedrock Credit America. We're your nonprofit for credit education and restoration. My goal today is to take a short amount of time to give you guys all the knowledge you need to have in order to make sure you have the best credit possible so that when you are ready to purchase, you're in the right spot. I'm going to start with a question. Who here uses Credit Karma? Okay, ready? Please stop doing that. Okay? That number is completely inaccurate compared to what the bank uses because what they're giving you is a credit report and a credit score. And all day long, I sit there and talk to people, and I have the same question every day. Well, I went to Credit Karma, I had a 680, and then Beth pulled credit, and it's really a 620. What is going on? Literally, it's apples and oranges. It's two completely different scoring models, and they're not even close. So please don't use Credit Karma or any other third-party website like that. Not only is it inaccurate, did you know that they're selling your personal information? Yeah. That's how they make their money. They're not giving you a free score because they're nice people. They're making their money on the back end. So stop doing that. Now, the next thing you're going to think is, well, Steve, I want to see what's going on with my credit. So how can I do that? If you just want to see your 7-year content, you can go to annualcreditreport.com, and every week you can pull your credit from Equifax, Experian, and TransUnion for free to see your 7-year content. It's not going to give you any scores. But annualcreditreport.com gives you the ability to go there at the credit bureaus, pull your credit, and make sure that your content is looking the way that it should be. Meaning all your payments are showing up, there's no collections that popped up that you weren't aware of, all that good stuff. What if you actually want to see the same information the bank sees? Where you can go for there. For that, you have to go to myfico.com. www.myfico.com is literally the only website to give you the exact same score that the bank uses. It does not count as an inquiry. It does not impact the credit in any way, shape, or form for you to go there and look at it, but the catch is you have to purchase it. Generally, the cost is $30. But if you went there and you purchased your score today, you're going to get the same numbers that Beth would pull on the mortgage side. Keep in mind, however, that there's different versions of your FICO score. And I'm sure some of you are thinking, well, Steve, I don't need to do that. I have my FICO score. It's on my credit card statement or my bank statement, right? Well, is that the same score that Beth uses? No, it's not. Why not? Because what Beth uses and all lenders in the U.S. are currently using is known as FICO Classic. And FICO Classic, again, you can only get it through the lender or through myfico.com. But what they're also giving out to the public is FICO version 8, 9, and 10, and that's what they put on the bank statements and the credit card statements and all that good stuff. Okay? So that's how all of that works. Questions there right now? No, I know we're going to do questions at the end, but all right. You can go to the next slide. The next slide is just looking at, well, what makes up our actual scores? What's it all about? Now, you can see it there. I'm not going to go into full detail with everything, but there's a couple key components of things that I want to make sure you guys fully understand. If any account goes into a charge-off or a collection status on your credit report, that's negative, right? Meaning that negative payment history means that you weren't able to make the payment on time, or something like a cell phone bill, you didn't get to make the payment, it got kicked to a collection company throws themselves on your credit. That type of activity is going to drop your scores. But the question is, how do we address it if it gets there? Well, a lot of people think, well, okay, Steve, I owe the money, but it's a lot of money, so let me put myself into a payment plan so I can just kind of catch up, pay it off in the next 6 to 12 months. That should be okay, right? No. Never, ever, ever allow yourself to go into any type of payment plan if an account's in charge-off or collection. Okay? Number 2, all right, Steve, I get it. I'll go in there and do a one-time settlement. That should be easy enough. I owe $1,000. They're willing to let me pay for $600. Let me just call them up right now, get this thing taken care of. No. You should never, ever, ever give out your debit card, credit card, or checking account information to any type of collection or charge-off. Okay, one real-life example. There was a lady a few years ago, this was like 4 or 5 years ago. She had a collection for Verizon for $1,000. ABC collection company was trying to collect on it. Okay, call. Finally, she's like, what do you want? You got to pay your bill. Fine, I'm not paying you full $1,000. I'll settle for $600. Here's my debit card. They said, okay, fine. They took the $600. She thought she was okay. Ready for this? 4 months later, a different collection company calls and says, hi, we're calling you about your Verizon debt. What does she say? Oh, so you're verifying it was your account. Thank you. Click. They then went into the debit card she gave the first company, pulled out $1,000. 100% illegal, as our attorney would say, but that's the type of stuff, these shenanigans that these collection companies do. And in the past 16 years I've been doing this, I can tell you story upon story about that type of stuff. Point being is, protect yourself, never give out your debit card, credit card, or checking account information. Good? Now, a little bit of good news since the last time I was here last year. As of July 1st, 2022, if there's a medical collection on your credit report, just an FYI, that medical collection, even for $50, is going to negatively impact your credit. But as of July 1st, 2022, the credit bureau said, well, if you pay that medical collection, not other collections, not like a credit card or a cell phone bill, but if you pay your medical collection, within 30 days, it'll be deleted off your credit report. So that's huge. So if you do have a medical collection, work with your insurance or out of pocket to get it paid. Within 30 days, it's going to be deleted. Okay? They then took it a step further. The credit bureau said, well, we're going to help people out a little bit more. As of March 30th, so later this week, finally, March 30th, 2023, any open medical collections under $500 are going to be wiped off the credit report. That is huge. People's scores are going to skyrocket going into April because those $50, $100 copays that they didn't even know about because the doctor didn't send them a bill. And that's it. I didn't even know. I didn't get anything in the mail. Yeah, well, they just sent it to collections. And that's killing people's credit report now. But as of, I think Friday, right? Thursday or Friday, any open medical debt, as long as it's under $500, off the credit report. If it's over $500, it's still on there. It's still going to be negatively impacting credit. But once it gets paid, it's then deleted within 30 days. We good on all that? Beautiful. Let's talk about debt utilization real quick. Debt utilization simply means how much money do I owe versus my credit limits. So if you have a credit card with a limit of $1,000 and you owe $1,000, you're at 100% utilization. That's going to be holding your scores down. Well, Steve, it doesn't matter. The day I get my bill, I paid in full. Is that okay? No. Why? Because the credit card companies only update the credit bureaus one time per month. The day they send you that bill, whatever that balance is, that's what shows up at the credit bureaus for the next 30 days. So even if you get your bill and you pay it that day, unless you don't use it for the next 30 days, so it can actually reflect a zero balance in 30 days, but if you pay it and then say, well, I got to spend and I got to use and I got stuff to do, and in the next 2 or 3 weeks you're spending again, by the time the billing cycle comes out again, it's having a high utilization, and that's going to hurt your scores. So what do we need to do? We need to focus on making sure that we're keeping our balances as low as possible. And I won't go through the whole algorithm of it, but the bottom line is the lower you have it, the better it's going to be for your credit, keeping in mind that specifically 30 to 60 days from when you actually want to purchase something, that's really when you want to optimize your scores and pay everything down to zero. But when you do pay it to zero, do not close the account. Closing accounts can significantly impact your credit, negatively, obviously. So think of it this way, right? Let's say you have a credit card for $1,000 and another credit card for $1,000, okay? This card you max out every month, but this card has a zero balance. Right now, we're at 50% utilization. It's not great, but it's not terrible. We can work with that. But if all of a sudden, this card over here, either because you haven't used it in 6 months, which is generally the rule of thumb, where they're going to close it on you, or because you say, well, I don't want this card anymore, and now this goes away, by simply closing that one credit card, you're now going to take your utilization from 50% to 100%, and your scores are going to tank. So where you might be like, yeah, Steve, it's not a big deal. I just want to close it. That could actually really hurt the scores, so don't allow that to happen. On the flip side of that, you might be in a position where you say, well, maybe I need to start building credit, and maybe I'm going to start opening accounts. It's okay to open accounts, but you have to realize that every time you open up an account, you're going to take a hit for an inquiry, more on that in a minute, but you're also going to lower the average age of your credit file, which is 15% of our score, as you saw. So if you're constantly opening up new accounts, whether it's a car loan, whether it's a mortgage, whether it's a credit card, whatever it is, every time that new account comes into the system, it lowers the average age of your credit file, and that's negatively going to impact the credit. So you got to be very careful about when should I open up accounts. And I do have people that come to me and say, well, Steve, I want to buy a home in the next 3 months. Well, then you can't go open up anything right now, because when you first open up that account, it takes at least 6 months of on-time payments for that to go from a negative account to a positive account and help your average age of the credit file. Well, what if you're saying, well, Steve, I need to boost my credit a little bit. I literally just did, feel free to, by the way, to follow me on social media. I just did a video on this on Friday. And what I was talking about is, how can I help boost my credit within 30 days if I'm trying to be able to purchase a home very soon, right? Well, obviously, the first one we just talked about is the debt utilization and paying down your credit cards. That's great. But the authorized user relationship is another awesome tool to use right now in our current system that allows us to be able to hop onto somebody else's credit and boost your scores. Let me explain. Say you have somebody that's at a 605, okay? And they need to be above a 620 based on the certain type of program that you're trying to qualify for. If that person already paid down all their credit cards and now they're just looking to try to grab those extra 15 points, the way you can do that with the authorized user relationship is they find a friend or a family member that's had a card that's been open for at least 10, 15, 20 years, and they tell that person, please add me as an authorized user to the card. As long as the card is a MasterCard or Visa, not American Express, it's been open for anywhere from 10 to 20 years with no late payments and a zero balance, within 30 days, that 20 years of positive credit history shows up on that person's credit report and can significantly boost their scores. So it's a great way in a short amount of time to get those scores up to where they need to go. And by the way, say this person at 605, it's a 605 because there's late payments or collections or things like that. None of that negative information can impact this person that they're getting added to. So it's a one-way street. It's helping that person, but none of that negative stuff can help, it would hurt the other person. Make sense? Perfect. Next thing I want to talk about is inquiries. Inquiries are a very unique animal. Number one, they're only 10% of your score, as you saw about. Okay? And I get people all the time, well, I have a 520 score, and it's because Bob ran my credit 10 times. No. You have a 520 score because you have terrible credit and you don't know how to pay your bills. That's the bottom line, all right? But with inquiries, though, with mortgages and auto loans, you actually have a 30-day window to go shopping around, and it only impacts your scores one time. So you could go to 20 different lenders on the mortgage side within 30 days. All 20 of them will be listed, but it only impacts your scores once. And that inquiry itself, being only 10% of your score, 5 to 10 points, maybe up to 15 if you're really shaky on your credit. Same thing applies for auto loans. You have a 30-day window. You could go to 20 different lenders, and they're going to shop around your auto rates, and that all of them will be listed, but it only impacts your score one time. And by the way, with the mortgage score, everything has to be FICO Classic, because that's what all banks use. With the auto loans, it's a Wild West. You could go to one place, it's a 706. You could go to another place, it's a 685. And it's simply because they use a certain type of scoring model and somebody else uses something different. So there's variations there. So just kind of keep that in mind. Good? All right. That's the main information I want to give, and I want to let everybody else speak. The last thing I just want to mention is making sure things are reporting accurately, because one of the biggest things I've seen, especially lately, is that certain companies don't report the credit limits. And that causes a problem. Why? Your debt utilization. Think of it this way, right? You go and apply, and I'm going to pick on Capital One because Capital One seems to be the biggest culprit of it, and a lot of people have it. You have Capital One, right? So you say, okay, my score is 700. I want to apply for a Capital One credit card. They say, okay, great. Here's your Capital One credit card for $1,000. Say, okay, great. I was just listening to Steve's presentation. I'm only going to put $100 on it. I'm only at 10% utilization. Not bad, right? Well, a couple months later, Capital One decides to do an account review. But in doing this account review, they've now stopped reporting the credit limit to the credit bureaus. So now, when they do their account review, they look and they say, okay, what's the balance? It's $100. What's the limit? Oh, there's no limit listed. Oh, it must be $100. So what just happened to your utilization? It just went from 10% to 100%. Your score just went from 700 to 640. And then they call you up and say, oh, by the way, we're raising your introductory interest rate from 3% to 23.9%. What are you talking about? Well, your score dropped 40 points, 60 points, whatever it was. But they're the ones that did it. Crazy, right? So point being is, don't go, I know some of you saying, I'm going to cancel my Capital One today. Don't do that, okay? We've already talked about don't close cards. But just make sure you're monitoring your credit and making sure either through annualcreditreport.com that everything's accurate or through myfico.com to make sure that things are where they need to be. If anybody has any questions, I'll be sticking around. You have all my contact information. I always offer a free consultation if you want to review your credit or if you just want to ask a question, feel free to reach out. But I'm going to keep it short and sweet. Thank you very much.
Thank you, Stephen. Again, please contact Stephen before you even come to a mortgage professional and you know that you have some credit issues. Please give him a call. He's really very good. Now we have HDF, Roxana and Jackie. Thank you. One more reminder. Everybody signed in? Everybody, right? Okay, thanks.
Hi, good afternoon, everyone. Part of me likes to be connected to the clients. But thank you, Beth, for the invitation, and thank you to First County Bank, and thank you to New Vision for having us today here. But I work at Housing Development Fund. We are a non-for-profit organization, and our mission is to help first-time home buyers buy their first home. We have two departments. We have the counseling department, and then we have the lending department. I have my colleague here, Jackie Alves, and I will be talking about the counseling part and the loan products that we have, and then my colleague, Jackie, she will be talking about the underwriting criteria. So first, there is eligibility criteria. We have down payment and closing cost assistance. And clients have to be first-time home buyers. And that means that they have never owned a home, or if they own a home, they sold that home at least 3 years ago. Also, clients could buy a single-family house, they could buy a multi-family house, or they could buy a single-family house. Unfortunately, co-ops do not qualify for our programs. Also, we count the household income. The household income cannot exceed $135,900 if you're buying in Fairfield County. Anywhere in Fairfield County for our Smart Move program and another program that we have that is called Equity Fund, your income cannot exceed, the household income cannot exceed $135,900. Also, we take a look at the credit. I know Stephen talked about credit, but that is one of the underwriting criteria for the Smart Move loan and the equity loan. Clients, basically, they cannot have any past dues, collections, charge-offs, but if you do, you have to pay them. And now in the counseling, we pull a credit report. You have the option to we can pull a counseling credit report, and it's a soft inquiry. It won't affect your credit, but at least it gives us the opportunity to review and see if there are any credit issues that maybe is preventing you to get a mortgage. So we take a look at the credit report, and a counselor will tell you what is it that you need to do on your credit to be ready. We also look at your savings, because you need to have at least 1% for the purchase price. You also need to have for the inspection, the appraisal fee. You also have to have at least 2 mortgage payments in reserves. Also, if you're buying a multifamily, you need to have at least 4 mortgage payments in reserves. So that's why we want to see how is your savings, how is your credit, because in the counseling, we can help you get ready. So when you go to the bank, and First County Bank is one of our participating lenders, then you will be ready. You will be mortgage ready, so they can give you a pre-qualification or a pre-approval. So that's why we offer the counseling. We offer the counseling to identify what areas are preventing the client to buy a home. Also, we do classes. We do the classes in Spanish and English. And the classes are 8-hour classes and are free. We're doing it right now via Zoom. I'm gonna have my class in Spanish on April 30th via Zoom. And then the one in English will be on Saturday, June 10th, also 8 hours via Zoom. We have 2 offices. We have one office in Stanford, which is located at 100 Prospect Street. And then we have another right here in Bridgeport at 1111 Main Street. So I invite you to go to one of our offices, or if you prefer, you can go to our website, which is www.hdfconnects.org. And when you go there, you will have to upload documents because, like I said, we have to make sure that you are income eligible. We have to make sure that you are a first-time home buyer, that your income doesn't exceed the income limit, and we take a look at your credit as well. So you need to upload. We want to see, you can either do it on our website or you can go to one of our offices and submit the paperwork. You have to fill out an intake form. You have to submit the W-2s for the past 3 years for the applicants, also the tax returns, the federal tax returns for the past 3 years, the 2 most recent pay stubs for everyone in the household, a copy of your ID. Also, for our programs, you have to be a U.S. citizen, U.S. resident, or one of approved visa with a work permit. On our website, we have a list of the visas that qualify. Also, you have to submit an intake form, you have to fill it out, and you have to make the payment for the credit report. Now, what are the programs that we offer? We offer down payment and closing cost assistance, as I mentioned before. Our first program is called a Smart Move. And the Smart Move program, we can lend you up to 20% for the purchase of the home. And the benefit of that is that you don't have to pay PMI, and the interest rate is at 3% fixed for 20 years. So if you qualify, if you meet the criteria, we can lend you up to 20% for the purchase of the home. And then you are going to have 2 mortgages, one with the bank for the 80% financing and the other 20% with HDF. In addition to the Smart Move, we also have another program called the Homeownership Equity Fund. If you are Hispanic, if you are Black or African American, Asian, Native American, Alaskan Native, you may qualify for an additional $20,000 for the purchase of the home. Now, the $20,000 is at 0%, no monthly payments, but you do have to pay back when you sell, refinance, transfer title, or when you finish off paying the first mortgage. You have to pay it back in full. Also, we have a third program. If you're buying the city where you work, either one of the applicants have to work in the city where they are living, you can get an additional $20,000 for the purchase of the home. And that also is at 0%, no monthly payments, but you do have to pay it back when you sell, refinance, transfer title, or when you finish off paying the first mortgage. You have to pay it back in full. Now, if you're buying Stanford also, through the city of Stanford, there is an additional $20,000 for the purchase of your home. And we do all of the paperwork on behalf of the city of Stanford, so you don't have to do an additional step. And you can have access to another $20,000. So we have different programs to help you buy a home. So oftentimes clients, they think, well, I don't know where to start. I think counseling will be the great first step for you to see, just to have an idea if you're ready or not. I have clients that it took them 4 years to get ready because things happen. But then I have clients that they come to us and they are ready. And then after they are ready, then we send them to the bank, and then they get pre-qualified, and they go to the realtor, and they start buying a home. But if there are things that you need to work, we'll help you through the counseling. All right? Thank you.
Thank you, Roxana.
Thank you, Roxana. My name is Jackie Alves. I also work with the Housing Development Fund. I'm the Director of Residential Lending. So the difference is Roxana gets you ready for mortgages, and then I provide the financing for the mortgages. So we are a counseling agency. Our goal is to get you ready to become mortgage ready. One of the biggest obstacles is that people just don't know where to start. And like Roxana said, you hear the word counseling and you're kind of a little thrown off. It's like, why do I need to go to counseling to buy a house? It's homeownership counseling. They're going to go through every step of that process with you. make sure that you have a clear outline of what your next steps and what you need to do. They also provide you with a list of questions that you know you can ask your inspectors, you can ask your loan officer, so that you're getting all the information that you need. This is a huge purchase for everyone, and it's a necessary purchase for us. Everybody needs a place to call home. Anybody wants to stay in their community, and with the rising prices of rent, it's just becoming not easy. And so what we do is we figure that out, and then we move you, if you are eligible and you'd like to continue with our programs, we have a ton of different lending programs that you can stack funding towards in order to get you that down payment that's necessary. One of the issues with lending is that there are a ton of different acronyms and letters being thrown at you. So in order to purchase, most people think that you need 20% to put down. If you don't have 20%, then you have to pay private mortgage insurance. That 20% is extremely difficult to save up for when you're paying extremely high rentals. And we completely understand that, we know that, and that's where we come in. So we give you that 20% so that you're not paying that private mortgage insurance to the bank. Instead, you're paying a second mortgage, you're building equity, it's at a lower rate, and you're paying your home off quicker. What we focus on is everything that the same bank focuses on. Our partner lenders have the same requirements that we do, and so we're going to go through everything that Beth said. Your tax returns, we're going to look at 3 years to make sure that you are actually a first-time home buyer. So first-time home buyer means that you can't owned or had any benefit of owning a property in the past 3 years. That's why we need to look at 3 years of tax returns to make sure that nothing is listed. Correct, that's through Connecticut. We also lend in New York. It's the same definition in New York. And so the next thing we're going to look at is your income. Like Beth said, we want to make sure that there is steady income. We're going to average 2 years. If it's hourly, if it's salary, we take your salary. But we're going to look at that as well. What we're looking for is to make sure that you are under our income levels. As Roxana said, for Fairfield County, it's $135,900 is the maximum household income. And we're also going to use that to make sure that you have enough funding that you can pay for the home. So we want to make sure that you are under our debt to income ratio, and we look at that as well. We're also going to make sure that your credit is up to date. And so, as Roxana said, they're going to go through your credit. They're going to make sure that nothing comes up. We don't have a credit score minimum. It's whatever the bank says. So if they put you in a program that you need a 660, then we're just going to look and make sure that there's a 660. The other thing that we look for is, while we're giving you 100% financing, which sounds great, which means you don't need to come to the table with any money, you do have to have some savings. There are things that you're going to pay out of pocket. There are the requirements. You will have to pay for an appraisal out of pocket. We won't cover that in your closing costs. You do have to pay for a home inspection. We won't cover that either. We also require you to have 2 full months of mortgage payments in the bank if you are purchasing a single family or a condo, and we require 4 months of mortgage payments if you're purchasing a multifamily home. The reason that we require this is so that there is some cushion there. Things happen. We want to make sure that you're going to be able to make those repairs, or any emergencies that come up, that you have a little bit of a cushion there. With that being said, that sounds like a lot to have in the bank on top of any closing costs or anything. That's why we provide closing cost assistance to help you get there. Lender credits are available as well. Some seller credits, always good to talk to your attorney about working that into the contract. Things like that. So what we're trying to do is get you into a home with the least amount out of your pocket, but still make sure that you are comfortable and that you are prepared for anything that may come up. Roxana touched on our loan programs. There is the Smart Move, that's our main one. That is up to 25% of the purchase price. That will cover your down payment to eliminate the private mortgage insurance. It will also cover some closing costs. In addition to that, we do what we call layering. So you can get more than one program on top of each other. So we do have, the rest of our programs are 0% interest. It is not a grant. You do have to pay it back, but you will pay it back at the end of 30 years or when you sell the home. They're great because it increases your purchase power. You can now afford more because they are 0% interest. It's not adding to your monthly debt. So they're great for that. Live where you work, she touched on. You do have to purchase in the town where you currently work. The good thing about that is it can be a full-time, can be a part-time job, and if you are work from home, that also qualifies. So a lot of people have transitioned, so that's a really good benefit of that program as well. The Equity Fund is a great program, again, trying to keep people in their communities where they want to stay rather than making it unaffordable. We're trying to help them remain in the communities. That is another additional $20,000. So think about it this way: on a $200,000 house, you could get, $40,000 in zero interest, as well as another $40,000 in 3% interest, which is significantly lower than what the first lender is telling you. So that really increases your purchase power there. We go through the same programs and procedures as the first lender. So you're going to go to Roxana. You will get your counseling done. You'll make sure that you're mortgage ready. You have your pre-approval. You're going to contact a realtor if you haven't already, which is usually the first place to start anyway. But get a realtor. You're going to make an offer on a home. And then once you have that, you would come back to us and you would submit your lending application at the same time that you submit your lending application to the bank. So while they've done a pre-commitment, all we'll do is just review and make sure nothing has changed, and we'll move forward. So we try to keep it to a minimum, and try not to tack on any additional timing to your closing. We work with the bank in conjunction to try and get you to your closing date as quickly as possible.
Yeah, thank you. Now, just to clarify, thank you, Jackie. So one of the things I'd like to stress is there's a lot of money being given out there right now, but you need to understand that towns and the state of Connecticut offers these down payment assistance or mortgage assistance because they want you to stay in Connecticut or in the town for a period of X number of years. Most of them require you to actually stay at least 10 years. And if you sell or you give up your title, you will actually pay prorated of those down payment assistance that you may get. So keep that in mind, because I have had clients that refinanced a couple of years ago and they said, why do I owe $25,000 added to their principal that they owe? Well, you know what? You did an HDF, they gave you $20,000 plus an additional $20-something thousand from the city, and now you're actually giving it up less than X number of, now you have to pay this in addition to the principal that you owe. So always keep that in mind. People think that, oh no, it's free money, it's mine, I'm not gonna have to pay it back. She stressed it many times, you will have to pay it back, okay? It's after you sell the house, you switch title, refinance, right? Yes, you will have to pay it back. Now, now we have the closing attorney, actually. None other than my better half over there. Is it the inspector first? No, it's the attorney first. Yeah, the attorney's first.
Okay. I'm going to do this from a seated position, so you'll forgive me, but I'm old. So you've decided to buy a house, and you've talked to a broker, and you've talked to a mortgage person, and you're ready to go, and you're out there, and you, in today's world, probably have looked on the internet and looked at all different kinds of properties out there, and you finally say to your broker, "Show me what's out there." And you look around, and you come to a property that you like and that you want to make an offer on. The question is, what happens then? And the answer, unfortunately, is almost every kind of possible alternative. When we did this last year, when we did this last year, is that better? I think I wrote out 3 pages of possible scenarios. What I'm going to tell you is, when you are ready to make an offer with your broker, the broker will provide you with a document. It could be called a binder. It could be called a memorandum of offering. It could be called a purchase contract. It could be called lots of things. It depends on the town you're in. It depends on the broker that you're dealing with. It depends on what company they work for. It may depend on what the seller has indicated in the listing they want as an offer sheet. There's no way to know exactly what it's going to look like. What it should include is obviously the purchase price that you're offering and any credits that you're asking for. Closing cost credits or building credits. It should have a mortgage contingency in there for most people. Unless you're paying cash, you want to put in, make sure that the document has the opportunity for you to get a mortgage, and that will say how much of a mortgage you're looking for, and a date by which you have to notify them if you've gotten your mortgage. There should be an inspection contingency. You want the opportunity to bring in an inspector to look at the property and to make sure that there are no unusual problems. Things like the inspector will, and we'll leave that to my colleague down there, but termite, radon, well and septic, if those are applicable to the property, all of those items, the roof, and so on. You're going to want a title contingency and a municipal search contingency. Title is for your attorney to check to make sure that the property is owned by the seller and that it's free and clear, and that tells you if there are any claims against the property. And a municipal search tells you whether there are any open building permits or zoning permits against the property, which could come back. If they're not resolved, they could come back to haunt you in the future after you take title. So all of that goes into this document, and then it generally goes to the seller's attorney, who, under one of the scenarios, prepares a formal contract and presents it to the buyer's attorney. In today's world, there is much more use of broker form contracts. They are generally 3 to 4 pages, and they are binding contracts if you sign them. So the one thing that you need to keep in mind when you're signing this document, whatever it says on it, is that it provides for the ability of your attorney to review the terms of the contract within it's usually 5-day period. That's important because otherwise you may have signed a binding contract that contains provisions that are not in your best interest. Not only should it have the attorney review contingency in it, but please make sure that you get it to the attorney in time. Sometimes in today's world, the contract doesn't get to the attorney until after the inspections are done, and that can be too late to exercise the review provision. So my suggestion to each of you who are thinking of doing this is to make contact with an attorney that you trust as soon in the process as possible, okay? Most people will be more than happy to spend some time on the phone talking to you, get to know you, you can get to know them, and to get some idea of what their costs are, what they will do for those expenses, and to give you someone to call if you're unclear about what it is that you're signing at that point in time. Let's see. I spent too much time the last year when we did this, so my wife has told me to be very brief. Not an unusual request, by the way. After the contract is signed, excuse me, you'll spend some time with the lawyer, either in person or on the phone or electronically in today's world. And the lawyer will start the title review process. They'll order a title search, they'll order a municipal search, and you may not have contact with them on a fairly regular basis for a while. During that period of time, you are working with your mortgage lender. You're getting lots of those documents that Beth was talking about. We're waiting to see that your mortgage has been granted, and we're keeping track of the mortgage contingency date because that's a very crucial date in the process by which you have to notify the seller that you either have or have not got your mortgage. If you haven't gotten a mortgage, if you've been denied, then you can exercise the contingency and you can get your deposit back, and you're out of the deal. At some point, once the lender is ready to close, you will at least 3 days before the closing date, you will get what's known as a closing disclosure. That's something that's prepared by the bank, by the lender, the mortgage company, with the help of your attorney, getting numbers from both the bank and the attorney and the selling side of the transaction. And it will go through, it's a little complicated, and the important number is the one at the bottom of the first page, which says how much cash you have to bring to the closing. Okay, that's an all-in number. That's everything that you have to have available to close the title. And your lawyer will probably ask you to wire him that money, him or her that money, a day or two before the closing. We don't do the typical, when I started doing this, actually, closings involve people sitting around a table, signing papers, handing checks back and forth, handing deeds back and forth. It doesn't work that way anymore, and especially after COVID, it doesn't work that way anymore. You as a buyer will be asked to meet with your attorney. You'll sign the mortgage documents with your attorney. You may have, depending on what lender you use, you may have signed some of the documents electronically with your mortgage lender. But in Connecticut, you need to have at least a certain number of the documents, the note and the mortgage deed, signed in ink in front of your attorney. So you will be meeting with your attorney. Then your attorney will meet or work with the selling attorney to get the deed, wire them the money, and then we're closed. Let's see. The closing disclosure that I mentioned a minute ago is a fairly complicated document. As I said, the first page shows you how much cash you have to come up with. The second page shows all of your costs, and that gets a little complicated. It's all the bank costs, all the legal fees, all the title fees, and it comes down to a closing cost number at the bottom. The third page is between you and the seller, the purchase price, the deposit, credit for the deposit, any adjustments for taxes or oil or water, those kinds of items. My suggestion is if there's any question about what all of those mean, that you call your lawyer and go through it with them. They'll be happy to explain it to you. It is not an easy document, and the government keeps changing it every once in a while to make it even more complicated. That's kind of what I was going to say. Thank you.
Thank you, Andy. I want to add something, and it's most buyers always make the mistake and call their mortgage person or mortgage professional to schedule the closing. Scheduling the closing is the job of your attorney because he has to arrange that with you, with the seller's attorney and the seller, to actually make a convenient date that works for everybody. Now, we're going to have our inspector. He's with Bob Camardo, who was here last year. I always ask clients who are also selling their house to actually get an inspection so that you also are aware of what to expect when your buyer actually gets an inspection. So to me, using the right inspector and doing the right inspection for the house that you're purchasing is very important because you don't want to own a house that has serious problems. Here we are, Joe Strait.
Good afternoon. Yeah, I'm an inspector. This is what I do. What is a home inspection? It's a visual inspection of the property. Something that I should be able to look at just like you and find out what this property is all about. We start on the roof. We look at the chimney. We look at the outside, the siding, the doors, the windows, the landscape, the grading, the way everything seems to affect the house. It's an important step, and I don't think anybody should skip this step. We go inside, we get in the attic, we look for the insulation, we make sure it's properly ventilated. We get into the interior walls, the ceilings, the doors, the the stairs, the smoke and carbon monoxide detectors. If we find problems, we usually have a list of contractors, or your agent will have a list of contractors to be able to remedy any problems that we do find. We go to the garage, we check the doors, the fire separation between the house and the garage. Again, that's a safety issue. We go to the basement, we check the foundation. I see a lot of concern when it comes to cracking in foundations, and Bob has actually educated me quite a bit with this, and we can put your fears to rest, or we can guide you to the right people that can teach you a little bit more than we can. But we talk about your furnace, your air conditioning, the age of it, what it's fueled by, if it's been serviced or not. That's a big concern. That's a big issue that we run into quite often. People update their heating and cooling, and they don't touch it, they don't service it, and that causes a lot of problems. So that's one thing we do. We like to bring in, when it's applicable, we bring in our heating specialist who will work alongside us and make sure that the system is up and running and is ready to go for when you guys do move in. We go into the electrical panel and we let you know what kind of power is, or how much power is coming into the house, where the disconnects are. If we find problems inside the panel, we'll let you know. We go through the plumbing, the water heater, if it's city versus well. If you have well water, odds are you're going to have a septic system. So that kind of brings us over to the things that aren't included with the home inspection. Water testing is not something that is normally included. Septic inspections, radon testing, those kind of things are above and beyond a typical home inspection, but we do offer it. You're going to want to make sure that you have the right people inspecting your home. The cost of a home inspection is between $500 and $1,500. It's typically, and it's based on the size of the house and how old the house is. Antiques, they're more expensive. There's a lot more that goes into an antique, and it's underwent several changes over the years that it's been on this beautiful planet of ours. But it's something that it's a step. The home inspection should not be a step that's overlooked. Take it seriously. Spend some time with your inspector. You're on site. You're looking through the house. You're being properly introduced to your house. So listen to the guy. And we've done this for a few years. I know between Bob and I, we've probably inspected close to 6,000 houses in this area. And we know how they've been built, how they're being built, and we're pretty familiar with the problems. So meet with us, ask the questions, and if you have any questions, feel free to ask.
The corners, actually, Bob, his partner, is an old friend of mine and my husband, over 35 years. And when we were looking at homes, I used him. I think we sent his son to college, right? Because every house that he inspected, he really went into the smallest spaces. He said there's black mold, there's no vent going outside of the ceiling, all the vents in the kitchen and the bathroom are going into the attic. Don't buy this house, they have rodents between the walls. You won't know that, you know. You won't know that. Or there are rats in the basement, or oh my God, there's so many. He took pictures of the rats that are in the crawl space in the basement that you never get to see. So it is very important to have an inspector go through, and with them, if there's a basement and they do the radon, or they will order a radon, they won't do it themselves. And also the septic system is very important. I can't tell you how many homes we looked at where they were representing that there was a proper septic system, and there wasn't a septic system. It was a cesspool. That means to say you have to pump it out every time it gets full. You know, so it's very important to have a home inspection. Please do not skip that, and please call them. Again, we present to you very, very trusted partners here. So please utilize them. I encourage you to utilize them. And if you need a mortgage and just, something to talk about of when you can get ready to buy a house, give me a call. I like chatting. My husband tells me I always chat with even the wrong number. So, so don't worry. Just give us a call. Now, if I may call Pastor Dexter, we are going to go into a Q&A, and we would like to draw the raffle winners. Is he here? Everybody signed in, right? Last call. Okay, come over here.
Beth, I forgot to say one thing. I have a document that I call a buyer's guide, which is 3 or 4 pages of kind of how the process works.
Here.
That I've developed over the years. If anybody's interested in getting that, you can take my card at the front desk and email me, and I'll be happy to send you a copy.
Make sure we can read it. You have to be present to win the prize. So we have 3 raffle prizes. So here you can actually. Sure. Yeah, go ahead while we're waiting. If you go ahead.
You're as tall as me now.
Yes, we summon you. We have 2 more signing in. Then we're going to pick the raffle winners. And you can bring it home. It's displayed out there. 2 more. Go ahead, ask the question while they're filling out.
Hi, my name is Maureen. I have a question about a second home purchase. I saw all the different possible interest rates for the first-time home buyer, but for a second property, does it have to be 20%, or are there other programs where you could vary the percentage down?
Second homes are considered investment homes. So some banks will offer 20%, and some banks, they're tighter now, will ask you to put down 25%. It depends on, they will look at the overall risk of the loan. So for example, what affects your rate and your down payment requirement? Your credit score, your reserves, your ability to pay, your debt to income ratio, and the type of house. So if your second home is a single family home, you have a better chance. If it's a multi-family, then they will require 25%.
Okay.
Okay?
All right, thank you.
I hope I answered that question. Thank you. Okay, I'm going to wish you luck. And
Thank you, Pastor Dexter. I said, listen, you're going to get your money. What I'm going to do, what we need to make sure is that the house will appraise that. I put 10, and then I had her do like a 10% for me. So 10 came from me, 10% came from me, and 10% came from her, and she just ripped up the note afterwards. So you can get creative, and technically they do have their 20% down. But as long as that seller gets, if it's $300,000 for the house, and they want you to put down 20% of that, 60,000, and then you have 30,000, and you say, listen, you want the 300, I'll give you the 3, but the house does have to appraise at that amount. But you can get creative like that. But you need to know that up front, so your realtor, so you can negotiate in the deal if you need to do that. But there's ways around that. It's always a way. It will show on your, it has to show on your closing of documents, but the seller has to agree for that. So they would actually hold a note for you. Okay?
okay, Pastor Dexter wants raffle tickets. So Paula and Pastor Dexter is going to pass out some raffle tickets that you are going to have, and then we'll draw it. So anybody else with a question? No questions?
Question.
Go ahead. Please come to the mic.
So
So the program that's for the first-time home buyers, where you can work with the counseling session to, gain funds, is that something that's for second-time investment properties as well? Or is it
No,
only for
it's
first
not.
time?
It's just the
First-
down
first-time
payment
home buyers.
assistance are all for first-time home buyers.
Okay.
If you want to actually do investment property, you give me a call and I'll walk you through what's available to you for help, okay? We are a portfolio lender. Our bank is a portfolio lender, so we just don't do Fannie and Freddie. We actually lend our own money. So there's a little bit of allowance and leeway there for, okay, please. Your name?
So, Kalia.
Hi.
I have a question. So, my oldest son, I've had him on my credit since he was 16 to start him off with a credit score. So he has a really good credit score, but he doesn't have his own credit cards. Do you recommend that he gets one? I've been setting him up to buy a property by the time he's 20. So he has.
That's Stephen.
Yeah, he needs to, being added as an authorized user is a great way to have him generate a score. But in order to actually have him stand on his own 2 feet, in that situation, yeah, have him open at least 1 or 2 credit cards. If his credit isn't that strong yet, because maybe it's only 1 card that's only been open a few years, you could have him start with a secured credit card, which means you give them the money in advance and you apply for the application, and you have like a $300 limit usually. If his credit's strong enough, then have him apply for a regular credit card. But either way, once he does get a credit card, and in general, only put like $20 or $30 on the card every month. Wait for the bill to come. Say again?
I'll keep it. He won't.
You're going to keep the card? Yeah, well,
Because I'm setting him up to get his own property. So I've been.
that's fine, but somebody needs to use the card to keep it open and active, because if you open it and just kind of stick it in a drawer, then it's going to eventually get closed. So if you want to open it in his name through his social, and then you monitor it or hold it for him, just make sure it's being used. But when it is used, literally only $20 or $30 a month, wait for the bill to come in the mail, paid in full.
So he doesn't want it.
Yeah?
That's a good point that he said. If you put it in the drawer and you don't use it, you'll get a letter from the creditor saying, we haven't seen any activity, we're closing your account. Another thing. Wait, Matt has an answer too.
For that, usually I tell my clients, especially when they're working with small amounts and they're gonna just open it just to get credit. What I tell them to do is put something on like Hulu or Netflix, which is an automatic recurring charge. That way it'll generate a small monthly bill, and then you can just pay it. But it's something that you can set, put it in your drawer, you'll get the bill, and then you'll pay it, and that'll help you out.
Yeah, that's a very good idea. Very, very good idea. Because remember, credit, they want to see a history of your ability to pay on a regular basis. So.
Good afternoon. I know we talked about second home as being investment, but what if it honestly, your family has grown and you just need a bigger place, and maybe that second home would be like your primary residence? Do you still have to sell, or?
No, actually, okay, let's make this clear. If you're buying a second home, but it's going to be your primary, and you haven't sold the first one yet, lenders will look at that, and if the house that you're buying is bigger or in a better location, they will look at that as your primary, and then you write a letter stating that I'm going to plan to either rent my current home or sell my current home. They will consider that as a primary residence.
So that everything applies still with the 20%
Correct.
down
Yes.
and everything?
Yeah.
Okay.
Yeah. It has to, remember, it has to make sense to the underwriter. So if you currently live right now in a 2-family home and you're moving to a single-family home, they know that you're actually bettering your location and also your homes, right? But if you're actually you're now currently living in a 2-family home, and then you're going to actually move to another 2-family home, the underwriter is going to say, this is not a primary home, this is another investment property. Okay, go ahead.
Steve mentioned what not to do when dealing with collections, but I wanted to ask what you suggest, or how you suggest getting that off of your credit report.
So if you have an account that's in charge-off for collections, the first step is we need to contact them, verify the debt, make sure whoever's trying to collect legitimately has it. Then we get a settlement letter in writing, and now when we're ready to pay it, we only use a money order or a certified bank check. That way you're financially protected. And then we work with the credit bureaus to remove the negative data as well. So I'm happy to kind of give you a more in-depth. If you want to reach out to me, if you have my information, just reach out. I'll give you a free consultation. We'll explain exactly what needs to be done and take it from there.
Steve, do you have your business card?
I don't have my business card with me. It was just the information was up there, but feel free to come up and talk to me afterward. You're welcome.
I have two questions. Good afternoon. The first question is, if you're saving for your first-time home, does it matter if it's in checking or savings, or it's better that you have all the money in savings?
It doesn't matter, checking or saving, not under the mattress because we need to vet it. No, I do have clients that actually come with $100,000 that's in the mattress. We have to actually, the Patriot Act actually encourages or actually requires us to actually vet where the money is coming from. So in a checking or a saving account, in a 401k that you can borrow, anything that where we can verify where the source is coming from.
Another thing, if you had a property in your 20s and you're 50 now.
Oh, within the 3 years, if you did not own any property or you were not on title in the last 3 years, you are considered a first-time home buyer. So for example, when before I met my husband, I had a house, but I sold it. And then now we're buying another house and 10 years have passed and we have not owned a house. I'm considered a first-time home buyer, even if I did own a house 10 years ago. Okay, that's in Connecticut and New York, okay?
I had a question about the 3% that's put down when you purchase a home. I know they say usually a minimum of 3%, or I know it was mentioned that 1%. What if we put down a little heavier than the 3? Does that lower the mortgage payments, or is it kind of like a number that's set at the?
No. What she's talking about is that if you do a Fannie Mae, there are two types of first-time home buyer loans. There's the Fannie Mae Home Ready, which is 3% down. You can put 3% down, you will have mortgage insurance, okay? And it will, so for example, it's $100,000, you put $3,000 down, your loan amount is $97,000, so your loan will be based on the $97,000, okay? So now if you put more money down, let's say instead of $3,000, you're putting down $5,000, therefore your loan amount will be $95,000, and therefore your monthly payment will slightly decrease. Did I answer that question?
Yeah, you did. I just have a second one.
Okay, great. And then the government first-time home buyer, which is the FHA, you put down 3.5%. The problem with FHA that I have, I used to do a lot of FHA, is the upfront mortgage insurance and also the monthly mortgage insurance, which is for life. It's no longer something that you can remove. That's why for me, I prefer the Fannie Mae Home Ready, which is 3% down, no upfront mortgage insurance, and your mortgage insurance, monthly mortgage insurance, can be removed after 2 years, it has to stay at least 2 years, or when the loan to value reaches actually 80%. And many of the clients who bought a house a few years ago, because of the values of the house going up during COVID, they were able to come to our bank and say, can you remove the mortgage insurance? And they were able to remove it by ordering an appraisal, showing that now the value of their home is more and the loan to value is less than 80%, okay? With an FHA loan, you will not be able to do that. That is for life. You need to refinance, sell the home, get another loan to remove that mortgage insurance. And that's why I prefer the Fannie Mae Home Ready program. The rates are not really that much different, you know, like 6%, and FHA maybe because you've paid the points, you're probably getting like 5.625, and it's very small. Okay. Anything else?
Oh yeah, and my second question is, so once again, you have like all these providers here. As a person who's seeking to buy a home for the first time, brand new, what are like the order of steps? Do we kind of, if our credit is like seemingly okay and we wanted to get it better, do we see a credit provider, then a realtor, then go to HDF, or like what are like the steps?
Well, I always tell my clients to call me first because then I can proceed to actually refer them. If I see that you would qualify for HDF, I would actually forward you to HDF and say this is the best program for you. I think Vera mentioned that one of the things is I used to do CHAFA and FHA, and I do have outlets for that. If I see that this will be the program best for you, I will actually proceed to actually refer you to my partners that I trust who can actually perform or follow through with this type of loans. But I will try and see because I have an idea of the different programs out there, what suits you best. And I think there's somebody here that actually is in that program, and I made them choose. Do you want FHA? Do you want CHAFA? Do you want HDF? Do you want the Fannie Mae 3%? And I gave them the numbers so that you can make a sound decision. You need to understand each program, and then you make the numbers, what it entails and everything. So when you're doing the HDF or the CHAFA, they're more stringent, so they need more documentation than a regular Fannie Mae loan, okay? So sometimes some of the clients would say, I don't want to go through the hassle of that, we'll just do the Fannie Mae because I do have enough money. I had a client, actually, who has $500,000 in the bank and wants me to say that she would be approved for the first-time homebuyer HDF program. First of all, your income is more than the required income qualification. And she says, what do you mean I can't qualify? Well, because you make too much money and you have too much money in the bank. You know, so a lot of these programs that, you know, the time to own money that is available out there, people, it's more glamorous, sounding glamorous than the actual obtaining it. It's very difficult to qualify for those programs. It's very stringent. It's not just money that's being given away. So don't make the mistake to think that because they're $50,000 that Connecticut is offering you, that, hey, by the way, I will qualify for this. No, it's very tedious. Matt and I were just talking about that. Out of 9 last year that actually wanted to have, or I thought could go through that program, I only got 1 approved. And it was tedious.
Beth, can I just?
Go ahead.
I understand your question about who you go to first, and the problem is you need to go to everybody first. Your broker, you need a broker if you're going to go in the market. If you're going to make an offer, you need to speak to your lender because you're going to need a pre-qualification or some kind of a commitment, because a seller won't look at a buyer without some form of confirmation that there's a loan available. You probably should talk to the lawyer. If your broker wants you to sign a buyer's listing, a buyer's exclusive right, you may want your lawyer to look at that before you sign it, okay? The inspection may be a little later once you've got a property that with an accepted offer on it. But
and if you have a credit issue, I will tell you to probably call Stephen, you know. Because that's the first thing is we pull the credit and you find out.
The thing you're going to hear from a lot of people is this is the most important financial decision you're probably going to make in your life, and you need to get on board with a number of people to make sure that you do it the right way.
It may be the largest purchase of your life, and so therefore it's very important for you to take the steps. I'm very patient, so I will walk my clients through. And then the ones that I got from here last year, I would ask them to call the realtors that we have on board because, again, these are trusted partners. I mean, you don't want to get I'm not going to mention who it is, but there was a member here that went to another realtor and they were very disappointed with their experience. So it's very important to talk to someone that you know is going to guide you the right way, not to mislead you, and actually look at what is good for you rather than what is good for them, okay? And then these are our vetted people that we've presented to you. Yeah, it's a counseling program, and I have had some people actually sit in for that because it gives you an idea of, what you can do.
Okay. And as far as obtaining a loan for the home, if we're working with you at First County, are you looking at all the banks, like across the board, or are you only kind of looking at what First County offers?
I'm looking at our bank because I'm promoting my bank. But if I see that there is actually a program out there that best suits you, as I said, I will refer you out.
Okay.
Okay. Because, all the banks, one of the things that during an environment of rising interest rates, one of the things that we are actually noticing, and my colleagues in the mortgage industry, we're talking about this, is that like our bank has a very, very competitive low rate. So you have to understand and always remember that the true rate of lending is your APR. So for our bank, if I tell you your rate is 6%, the APR will be 6.009. What does that tell you? We don't have a lot of points. We don't have a lot of we have very low closing fees. 0.00, you're not even 0.10% of, of the loan, okay? Now, if you go to another lender, and this is where you look at the loan estimate or closing disclosure, some of the lenders now are very smart and they don't say, oh, no, you don't have any points, but they raise their closing fees. So all of a sudden, they're saying, oh, I'll give you 6%. But then your APR is 7.5%. Guess what? Your true rate is not 6%. Your true rate is the 7.5%. So somewhere in that form, you've either paid higher closing fees or you've paid points to buy down your rate to 6%. So you need to be very careful. I'm not saying that buy down is bad, but you need to be aware that that's what you're doing, that you're paying out of pocket. And if you actually roll this 1.5% into your loan, that $5,000 or the $10,000 that you borrowed extra over the years is not $5,000 and $10,000. Over the years, you're probably paying $20,000, $30,000, $40,000 for that $5,000 that you wrapped around your loan, okay? So for me, I'm a little bit conservative, so I like no points. And the rates are still low, that you don't really need to buy down the rate. I mean, 6% is still very low. And if you're a first-time home buyer with high credit scores, that can go down another eighth. There are ways of actually lowering that rate. I know rates are headed upwards, and they're saying that prices of home are headed upwards. And Fannie and Freddie actually confirmed that prices of home have actually increased. Why? Well, they increased the conforming loan limit to $726,200. In 2016, do you know what the conforming limit was for homes? $417,000. What does that tell you? From 2014 to today, prices of homes have increased by that much, okay? And you're seeing that now. Why? Well, they're saying there's lack of inventory, or there are too many buyers, not enough homes listed, the right homes, okay? Another thing is the supply chain that we had. We had a problem with builders' supply chain. I was talking with the owner of an appliance store who said that their appliances are back order for many, many, many months. So therefore, that's delaying. Another reason why interest rates or the prices of homes are going up is, I would say, I guess inflation, right? With inflation, all the prices are going up. So the things they use for building right now are also getting pricey. Did I answer your question?
Yeah, thank you so much.
You're welcome. Any other questions? Okay, Pastor Dexter, go ahead.
I was wondering, how bad does having a car note impact your process of getting a home? So, financing a car, if you wanted to finance a car and get a home, I heard it's a bad idea to finance a car before getting a home. Is that true?
That's actually a loaded question. I'll have Stephen answer.
Well, from a credit perspective, it definitely negatively impacts the credit, because you're going to lower the average age of your credit file, you're going to take a hit for that inquiry, and now you have that new account that's on your credit. And you're going to need at least 6 months of on-time payments for it to go from a negative to a positive. But then on the lending side, you have your DTI that now, whatever that monthly payment, that $300, $400, whatever it is, month, that now goes into your DTI, and that's going to change how much your purchasing power is. So it impacts the credit and the purchasing side of things. So the general rule of thumb is, if you want to purchase a home soon, don't do anything.
Right.
That's what I tell my clients. Once I pull their credit and analyze it, don't pass go.
Okay.
Don't pass go. Another thing also with the commitment, just because you got a commitment from any lender, whether it's our bank or another big bank or whatever, Commitments are not guaranteed. If you look at that commitment, like our commitment, there will be a section there that's bolded that tells you how this commitment can be canceled. And how? By borrowing extra debt that is not in the analysis of your loan, by losing your job, quitting your job. I had a client that actually quit her job 2 days prior to closing. And I said to her, "Are you crazy?" He said, "But we're already going to close." Right, and the bank checks the day before closing, they will actually make a call. Yeah, they're going to make a call and say, "Is so-and-so Joe Smith still employed?" And the answer was, "No, she quit her job yesterday." "Well, what are you going to pay the bank? Do you have another job lined up?" No, I want to take a break for a couple of months." "Well, guess what? You're not closing this house." "Oh, no, And this woman actually put a large down payment. She was going to lose that. She was going to stand losing that down payment. Lucky, we were able to be creative. We told her, "We have to actually now reassign the contract to your sons. Your sons will buy the house, and we're going to close this as fast as we can," because the seller of the house was on his way to Bulgaria and was happy to take home that down payment. So we did close it. We closed it after 5 days after we found out she lost her job, and we put her 2 sons in the mortgage and 2 sons in the contract. Okay? And those are the things that I'd like to stress, that the commitment, and the attorney is going to tell you that, commitment doesn't say 100%. There are loopholes that you can cause the commitment to be canceled. Not the bank, you. It's your doing. One is extending more credit that wasn't in the analysis. I actually had a client, which is really funny, and I always write this email: do not stop, do not pass go. Don't spend, because your debt to income ratio is right there, your credit is right there, you're in the border. Guess what? They update your credit just before closing. And they had this huge expense at the Bellagio in Las Vegas. So I picked up the phone and I said, "What happened?" "Oh, we got married. We had a wedding." Well, guess what? It's already in your credit. You can't afford the house. You can't qualify. Your debt to income ratio went skyrocket up. You're not approved. So we had to actually now figure out how to pay that debt and all that stuff. It becomes a wrench thrown into something that would have been a good experience. So, any more questions?
Yeah, Beth, I would like to add also that do not co-sign for your friends or even family members. I've seen many times when I look at the credit report, I see clients co-signing, trying to help a friend to co-sign on a loan or a credit card, and then that person is not making the payments, and now it's affecting your credit as well.
Yep, do not co-sign, because you are going to be hit for it. Whether I didn't co-sign for my daughter because my credit report determines my license, my work license, and I had to explain this to her. So you are being nice to your friend, but then your friend is not being nice to you, and they ruin your credit. So do not co-sign.
Yeah, somebody with somebody's getting a first time purchasing the first time home. Somebody with a VA, with the VA loan. Is that would you recommend someone with the VA loan with another program? What's
The
the
VA
best?
loan actually is a totally different ballgame. I used to do the VA loan. You get a certificate to tell us what, yeah. They're not. You're not credit score driven. It's a great program. So if you're a VA, the first thing you should do is to go to your VA office and get that certificate that tells us that you have not used your VA privileges and what amount, because each VA has a certain amount. It's a very good loan. The rates are good. The closing fees, you don't have the mortgage insurance, okay? And the way they qualify is totally different. Yeah, I do have an outlet for the VA loan. Okay, let's actually pull the winners. You pull the winner and announce the numbers. So let's do we'll have the welcome mat. Is that the winner? That must be the winner.
See, this is why I wanted raffle tickets instead of just pointing blindly at the paper. Somebody would say.
Pointing blindly at the paper would be good, because then we don't have anything falling up.
But then the lawyer in the group would say, well, there's other considerations
I'll
at
hold
work.
it. You can,
What, it keeps on falling through? What's that? There we go. We'll shake the basket together, Beth. There we go. Vigorously. Y'all see the shaking?
Okay.
All right.
Oh, come on. She doesn't want to pull the winner. Go ahead. So this is the welcome mat.
9270. No, that's everybody. 855. 855.
So now you have to buy a house, so you have the welcome mat, right? So, okay.
So that's the
Now this
welcome
is
mat.
an iPad. I call it an iPad holder, but I use it sometimes as a cookbook or a book holder. It's really great also as a book holder.
All right. 685-9990. 685-9990.
Oh, look at this, our VA
All
guy.
right.
It's over there. Please bring the backpack underneath. Yeah. Okay, now the big winner. So we
Now
have
this
the
is
drum
for
roll,
the
right?
television screen.
Yes. Let's see.
All right. Eyes are closed. 685-9989. 9989. 685.
Who won it?
9989.
Oh,
You've got
there.
it? Oh.
Can you carry that? Thank you, Andrea.
That's
I'd
that's
like
a
to
blessed
introduce-
corner over there.
I'd like to introduce my colleague, Andrea. She is actually a very good teller supervisor at our Norwalk office. Oh, here. Thank you. Congratulations. Thank you again for coming, and hopefully next year we're here again. Please, again, I encourage you to call our trusted partners here that we present. What I'll do is I'll send Pastor Dexter the contact information so you have it at hand. I know that many of you from last year, I actually closed many of your loans. Thank you very much, and I have some of you also still in my pool of loans to be closed because you're still looking at home, looking for home. So I wish you good luck. So again, thank you very much, and happy Sunday, and God bless.
All right. Can we give a round of applause for our panel? Thank you guys so much for giving your time this afternoon. I just want to close this with a scripture and a prayer. Proverbs 24:3 says, by wisdom a house is built, and through understanding it is established. And so please take this information, utilize wisdom, get understanding about the process. Each of these panelists will be here so you can reach out and ask questions, get educated about what you need to do, and then ask the Lord to order your steps. May we pray? Dear Lord, we thank you so much for this time. I thank you for each and every person here. I thank you for their willingness to submit to knowledge and to gain as much information as they can. Lord, would you help them to synthesize the information for their specific situations? Would you connect them with the right professionals at each level of this? Lord, we pray for our community, and we just pray that people would find a level of stability and success, first with you and through everything that they do and everything that they acquire. We thank you for the homes that are represented here, some who are renting, who will eventually own, and we'll give you the glory for bringing us and connecting us together. Lord, we pray for each and every person on this panel. We thank you for their time. We thank you for their willingness to come to our community and to share. We pray that they would not suffer or lack for the time that they've spent here, but that you would bless them and bless their business for doing good business with integrity. And Father, we just pray that you would continue to build and to develop and to cultivate. And we ask you for your favor in this process. In Jesus' name we pray, amen. God bless you. Thank you so much for joining us today.